They are for really real estate. They're for long-term fixed assets. You can do equipment, but usually you're talking like a printing press, that those things last 20 years and they're, at least 6 figures, if not more. And those things are beasts that last forever. But generally 90% of the time, you're talking real estate, commercial real estate, and that's where a 504. And the way they structure it is almost like getting a first and second mortgage on your house, because there are 2 loans under the 504 program. The lender does a first mortgage, 50% of the total project. The SBA does a second mortgage, what they call a debenture. And that's anywhere from 30 to 40% of the project. And then the borrower comes up with that last 10 to 20%. The first mortgage, the way the lender structures it, it's really kind of up to them to a degree, and the market. But it's really, I could do it at 2% if I want. I could do it at 8% if the borrower agrees to it. But usually it's not those extremes. Okay, and it's usually tied to, like, say, the 5-year treasury note or something like that, because usually it's fixed, like for every 5 years or for 10 years. I've actually seen some that are fixed the entire life of the loan. But then there's also, to get this really kind of complicated, it could be where it's a 25 or a 30-year amortization, but it's a 10-year note. It's exactly what we're talking about with the balloon. So if it's a balloon note, then you're making your principal and interest payments for 10 years as if it's a full 25-year amortizing loan. But after year 10, the entire loan balance is due. There's some good and bad to it. Usually in that structure, it's less risk to the lender long term, so usually it's a little lower interest rate. It's usually fixed for either the full 10 years or for 5 and 5. And then at that time, it's now ballooned, which also in a way forces you as the borrower to either go back to the lender and say, hey, I want to refinance. Well, at that point, the lender goes, okay, let me see your financials. Let me see how your business is doing. Are you doing well? Are you doing poor? Do I really want to take this additional risk? Because really the first time I really did a deep dive was 10 years ago. That type of thing. Or your balloon is coming up close to 10 years and the lender goes, yeah, I'm not interested in giving you a new loan. You now have to go find someone else. But at the same time, while that doesn't sound, well, in a way, it's like, well, great, now I got to stop what I'm doing with my regular job and go try to find a new lender. Conceivably, though, you've been paying down that mortgage balance by 10 years, and your property should have appreciated over that 10-year period. So you should actually be in a pretty decent shape overall in terms of loan to value, that you should be okay with another lender unless your business is struggling and probably have bigger problems anyway, type of thing. So the first mortgage on a 504, there are different permeations to what it looks like and what the structure is. And you can always work with the lender that, hey, I really don't want to do a balloon, or I want to at least make sure it's a 5-year fixed, or hey, if I do a 5-year fixed versus a 10-year fixed, what would be my rate? Because sometimes if it's fixed every 5 years, it's usually a little lower, that adder to the 5-year, because now me as a lender, I can readjust it to what my cost of funds are after that 5 years. So therefore that reduces the risk a little bit.